Publicly traded real estate securities provide investors with indirect exposure to real estate markets through listed financial instruments rather than direct property ownership. These securities offer many of the benefits associated with real estate investing, including income generation, diversification, and potential inflation protection, while providing greater liquidity and lower transaction costs. The two primary categories of publicly traded real estate securities are real estate investment trusts, REITs, and real estate operating companies, REOCs. Because these securities trade on public exchanges, investors can gain access to diversified real estate portfolios without the substantial capital requirements and management responsibilities associated with direct property ownership. Real estate investment trusts, REITs, are specialized companies that own, operate, or finance income-producing real estate. To maintain REIT status, these entities must satisfy regulatory requirements regarding asset composition, income sources, and dividend distributions. A significant portion of taxable income must be distributed to shareholders, making REITs attractive to income-oriented investors. REITs typically invest in property sectors such as residential housing, office buildings, retail centers, industrial facilities, healthcare properties, and specialized real estate assets. Their business model focuses on generating rental income and property-related cash flows, which are passed through to investors in the form of dividends. REOCs differ from REITs in several important respects. While REOCs also own and manage real estate assets, they are not subject to the same distribution requirements imposed on REITs. As a result, REOCs have greater flexibility to retain earnings, reinvest capital, and pursue development opportunities. This flexibility can support higher growth potential but may result in lower current income distributions. Because REOCs often focus more heavily on property development, redevelopment, and strategic asset management, their performance may be more sensitive to real estate market cycles and business conditions than that of traditional income-oriented REIT structures. Valuation of publicly traded real estate securities differs from valuation of physical properties because investors evaluate both real estate fundamentals and equity market characteristics. Common valuation measures include net asset value, NAV, funds from operations, FFO, adjusted funds from operations, AFFO, price-to-FFO ratios, and dividend yields. FFO is particularly important because it adjusts accounting earnings for non-cash depreciation charges and gains or losses from property sales, providing a clearer picture of operating performance. AFFO further refines this measure by incorporating recurring capital expenditures and other adjustments relevant to long-term cash flow generation. Publicly traded real estate securities offer several advantages relative to direct real estate ownership. Investors benefit from liquidity, transparency, professional management, diversification, and lower transaction costs. Securities can be bought and sold easily through stock exchanges, allowing investors to adjust portfolio allocations efficiently. In addition, publicly traded companies typically provide detailed financial disclosures, improving transparency and facilitating analysis. However, these securities are also subject to stock market volatility, investor sentiment, and broader equity market movements. Consequently, their short-term performance may diverge from changes in underlying property values despite their long-term connection to real estate fundamentals. Investments in publicly traded real estate securities play an important role in diversified portfolios by combining characteristics of both real estate and equity investments. REITs generally emphasize income generation and stable cash flows, while REOCs may offer greater growth potential through development and capital appreciation. Performance is influenced by property market conditions, interest rates, economic growth, financing costs, and management effectiveness. Investors must therefore evaluate both real estate fundamentals and corporate financial performance when analyzing these securities. Understanding the structure, valuation, risks, and return drivers of publicly traded real estate investments is essential for effectively incorporating real estate exposure into modern investment portfolios.